Hi there, and a very warm welcome to the second episode of the Money Side Up podcast. This is the show for Australians all over the world, covering all things money and personal finance, from tax to investment planning to property investment to budgeting, all over the world, and of course, back home in Australia. Thank you very much for joining us for the second episode. My name is Jarrad Brown, Senior Financial Planner here in Singapore, and joining me on the podcast today is my friend and colleague, Joel Kerin, down in sunny Perth. Welcome, Joel.
Thank you, Jarrad. Hello, everyone. Now, before we obviously dive into today's episode, we just need to obviously cover off our legal disclaimer, obviously to keep our legal team nice and happy. Anything on this podcast should not be considered as financial advice. And if you do want financial advice or you want to understand how any of the topics we've discussed in the podcast today are going to impact you, please feel free to get in touch and we'll go through that personal financial advice process with you just to make sure that it is relevant and is appropriate to you. So we may as well just, I'll throw it back over to you, Jarrad. How about you give us a bit of an update on sort of what's happening in the world, obviously inflation, Christmas, sort of that data has come out now, post-Christmas rush. Yeah.
Yes, look, it certainly has. All eyes on inflation. You know, were Australians going to be responsible when it came to spending over Christmas? Often for most people, and we find this in Australia and most of the Western world, people don't stop spending money until it actually hits them, meaning they lose their job, their business suffers, they really see it in their bank account. Otherwise, they just continue to spend. So there was obviously a bit of concern around what that Q4 23 inflation data was going to look like. But the good news for anyone with a mortgage, anyone hoping that the Aussie dollar will depreciate, anyone hoping that interest rates will drop, I guess really the only ones not hoping for this were those with large cash balances in the bank, enjoying the relatively high interest rate they've been earning. But that inflation came in at 0.6% for the quarter. Now, that is obviously October, November, December of 2023. So Christmas captured in that data, Black Friday, all of the big sales that we see in Q4. Now, the good news of this is that if we annualize that figure, i.e. 0.6 multiplied by 4, that gives us 2.4%, which is well within the RBA's target of 2 to 3%. Now, that is the good news. What the RBA has come out and said this week, so time of recording, first week of Feb here, they've come out and said, look, we ultimately want to see inflation within our range more consistently, meaning another 1 or 2 or maybe even 3 quarters. So what does all of that mean? Well, it means that the RBA probably overshot, probably lifted rates a little too aggressively, but at the end of the day, that really doesn't matter anymore. What's done is done, and we can really only look forward. So under the new meeting schedule in 2024 with the RBA, the next meeting will be the middle of March, 18th and 19th, and then we'll get the May meeting. So personally, I don't think we're going to see any rate cuts in March because I think the RBA is going to want to see that first quarter inflation data at least. But look, time will tell. I know we'd all be waiting for a rate cut. I don't know about you, Joel, but those letters in the mail, those emails, your mortgage repayments are going up yet again. I think we'd all love to see the end of those. How about you?
Absolutely. It's, anyone with a mortgage, I feel like will be celebrating that. And even, in stimulating people to get into the market as well, obviously a lower interest rate, obviously is able to be managed more effectively for people with lower interest rates, starting to buy their first homes.
Absolutely. Look, and we'll see what happens in that space. But I think the good news is, we should be well and truly at the end of the rate increases. We can kiss those goodbye and hopefully say hello to some lower rates in the future. But look, the other change we've been watching down in sunny WA, other than your ridiculously hot weather you've been getting, as we sit here in our cool, steady 30 degrees in Singapore with 100% humidity and afternoon showers, is this granny flat update in WA. So, maybe give us a bit of an outline of what's going on there, what the government's thinking, what it could mean. Let's have a look at what it might mean for expats.
For sure. So Yeah, like I suppose all over the country, it's been very topical where we're sort of this housing crisis that's happening in Australia, and WA is absolutely no exemption to that sort of headline. So the Real Estate Institute of WA, or REWA as it's called here, obviously publish rental market vacancy rates. And typically a vacancy rate between 2.5% and 3.5% is what REWA would classify as what's called a balanced market. So if we look at December 2023, or the end of December 2023, WA's vacancy rate was 0.7%. So, they're very much under what we would call a balanced market in regards to rental properties. And naturally, we've got that sort of demand outstripping supply, which obviously pushes up rents and creates this housing crisis, as namely made in every media outlet. So the WA Premier Roger Cook, obviously, along with this sort of granny flat provision, also announced $2.6 billion investment in addressing obviously additional housing and social homes, addressing homelessness, and that's obviously to deliver 4,000 new houses in that social network. But when we're talking about this sort of granny flat provisions, this is quite exciting. In order to address the sort of housing shortage that WA is facing, is they've removed a lot of the red tape that comes with approvals around adding granny flats to the backyard, essentially. Now, me being originally from the East Coast, I've lived in inner Sydney for a significant portion of my adult life. There is no backyard. You do not have a backyard. And, moving to WA, this sort of 500 plus metered square block per se is very common still. So, and you've essentially just got a freestanding home on the front of it and a nice sizable backyard. And Roger Cook's come out and basically said, well, in order to address some sort of or to provide additional housing into the market for people to rent, we're cutting down planning approvals. Approvals to get a building permit will take a maximum of 10 business days to build a granny flat. And so that's obviously a very quick turnaround to have, right, here's my application. I'm going to have a granny flat start in construction within 10 days. So that's really sort of exciting. And then that essentially means you could be seeing additional houses on the market for rent within, let's say 6 to 9 months. Now, there's obviously going to be some sort of rules and council planning approval for any dwellings that are sort of in excess of 70 square meters. So, but even still, this is going to be no doubt, a sensible source of income for many. And, if we've got expat clients, and you've got, for example, a residence or an investment property here in WA, this can also be a potential opportunity to, add additional value to, certain properties, or add another source of income, whether you're living here, whether it's for investment purposes. So all round, it seems to be a very positive move to get, more housing onto the market.
Certainly an interesting one. I guess, I think expats are probably going to have to be a little cautious with this one. Everybody sort of looks at the headlines and think, great, extra income. But if you're a non-tax resident, that extra income tax rate starts at 32.5%. So don't ignore that one. And I think it's also important to bear in mind that not every buyer wants a granny flat in the back. I mean, it might sound great as a bit of a short-term income boost, but does the family look at that and think, oh, great, we'll come and live with you because now you've got this separate space in the backyard, or you can just never get rid of the kids because now they've got a separate dwelling to live in out the back. But as you say, a very interesting one. I think a positive step to address some of that housing shortage across the country.
For sure. And as well, urban, I think another one was urban infill. Perth in itself is, I think the longest metropolitan city in sort of the southern hemisphere, if not the world. If we look from sort of Alkimos down to Rockingham or Mandurah, if we consider that metro, that could be 150 plus kilometers long. So trying to get sort of that, still incentivize inner city living and sort of urban infill as well is a very much a real task for the WA government.
Absolutely. I must admit, every time I come back to Perth, there's a new suburb, and undoubtedly it's on the coast, further up or further down. But let's dive in. So we've got a fantastic guest speaker today. As we've sort of discussed in the first episode, every month or every episode of the podcast, we will have a different guest speaker joining us, where we're picking their brains to really uncover, demystify the world of personal finance for Australians at home and, of course, Australian expats abroad. So today we are very blessed, lucky to have Bradley Murphy join us today. He is the Australian expat tax expert. So, Joel, let's cut to the interview with Brad and let's see what he's got to share with us and to say. Bradley, a very warm welcome to the podcast this morning. Thank you very much for joining us, giving us your time. Really appreciate it. I'm sure everyone listening or watching is going to get a lot of value out of today. So first of all, thank you very much for joining us. I guess by way of introduction to everyone listening and tuning in today, Brad Murphy is the expert when it comes to all things Australian expat tax. Over 15 years experience across Australia, London and the US. Brad, gosh, we've worked with clients in Singapore and all over the world for, the better part of the last 5-6 years. So yeah, can certainly attest to you certainly know your stuff. So again, appreciate your time. Today we're going to really dive in, flesh out, I guess, a bit of a focus on what it means to become a tax resident of Australia, which I think for most people we don't actually want, but we do need to understand, and what it actually looks like to cease being a resident of Australia for tax purposes. And I guess what are, some of the common tips, traps, all the rest of what we need to think of. So if that all sounds good to you, we'll dive straight in.
Yeah, thanks, Jarrad. Thank you for the kind introduction and kind words. And great to be on the podcast.
Wonderful. Look, thank you again. Look, let's start at the beginning. So we'll start with the basics. I guess first and foremost, maybe tell us a bit about yourself, your background, Australian expats, tax. Not everyone's cup of tea, bit of an interesting direction. So start wherever you'd like to start and give us the backstory.
Yeah, sure. Well, further to your kind words earlier, Australian tax lawyer and Australian international tax advisor is my background. We look after Australian expats. Basically been doing international taxes for 15 years, have a lot of experience in the Asia Pac region, the US and UK. And our firm, I guess we're unique in that we just do tax planning and tax returns for Australian expats around the globe. It's a really niche and exciting area, and love working with Australian expats and helping people out.
Fantastic. Well, look, I think we're certainly lucky to have you in the industry, and obviously really good to know you and be connected with a lot of our clients, because you've certainly added a lot of value over the years. So let's dive into this concept of tax residency. We hear all sorts of weird and wonderful stories in the land of expats, particularly Aussie expats all over the world. So let's just start with the very basics. What is tax residency, and why do Australian expats need to understand it and really understand how it applies to them?
Yeah, sure. So tax residency is a really important concept in that it derives a lot of tax outcomes. For example, if you're an Australian tax resident for Australian tax purposes, you are subject to income on your worldwide taxation, including your employment income, your investment income from overseas. So it really does drive almost every tax outcome. So basically, as an Australian tax resident, you're paying tax on your employment income from in Australia and overseas, and also your investment income as well overseas. Whereas non-residents normally just pay Australian tax on their Australian source investment income. So, for example, if you're a non-resident working from overseas, you would not be normally subject to Australian tax on your employment income once you do cease to be a tax resident of Australia. So it's a really important concept, and certainly there's a lot of, I think, misconceptions out there in terms of when do you become an Australian tax resident and how can you cease being an Australian tax resident.
So, Brad, with that sort of concept in mind, do you just want to go into sort of what the differences between obviously being a tax resident and a non-tax resident would sort of look like in practice?
Yeah, sure. Yeah, so basically, if you are an Australian tax resident, that means that you are paying tax on, obviously your Australian employment income, but also your foreign employment income as well. So, for example, once you do trigger Australian tax residency, if you were still a resident of Australia, but say working in Singapore, Dubai, for example, in a lower tax country, you're still paying Australian tax on that employment income. So that's one key thing to be mindful of on the employment income side, but also on the investment income side. So if you're an Australian tax resident, you do pay tax on your global income. So from overseas sources too. So if you've got overseas shares, overseas property, those capital gains and income returns are also taxable in Australia for an Australian tax resident. Obviously, there is double tax relief under our tax treaties to offset double tax, but the Australian tax rate is often high and normally higher than overseas countries. So, normally becoming an Australian tax resident or remaining an Australian tax resident would normally increase one's tax burden as an overall comment. Whereas, once you become non-resident or if you're not tax resident of Australia, you only pay Australian tax on any Australian source investment income. And even that investment income is subject to special rates of withholding taxes, which are quite favourable as well. And in a nutshell, Joel, Australian investment income would include Australian bank interest, Australian dividends from Australian unfranked shares, and rental income and gains from Australian property is the biggest category.
So it sounds like what you're saying there. It's like, why would anyone want to be an Australian tax resident? But is there any, I suppose, how does the ATO essentially determine an individual's tax residency status? Like, is it anyone living here? Is it, or any Australian with an Australian passport? What does it actually mean to the ATO?
Yeah, that's a fantastic question. So in a nutshell, there are three main tests to look at for Australian tax residency. They are the resides test, the domicile test, or the 183-day test. And effectively, the normal rule would be if you're an Australian citizen or permanent resident actually living in Australia, you're certainly going to be an Australian tax resident. The key test to look at for someone looking to cease Australian tax residency for an Australian citizen or an Australian permanent resident would be this domicile test. And that test effectively says that you need to establish a permanent place of abode outside of Australia. And that really entails, leaving Australia for a permanent basis for at least a 2-year period. And at the same time, having employment ties and long-term accommodation and normally family going with you overseas to that country as well. So that's really, that domicile test is the key test to look at for someone looking to cease Australian tax residency. Whereas for somebody, coming into Australia, the resides test and the 183-day test are normally far more important to look at. So the obvious bright line test is if you spend more than 6 months of the income year in Australia, you're a tax resident of Australia for that year. But the other test too is the one that does catch people off guard a bit is the resides test, which is a far more subjective test and looks at all your circumstances in totality. So, if you would look at your family ties, your property ties to Australia, if you've got Australian property, especially a main home with family back in Australia, but you're spending time overseas, you can certainly still be a tax resident under that resides test for sure. So that's really a inclusive test. It looks at a number of factors to consider where you're residing and if that's Australia. And just quickly too, your visa status is also important. So if you come to Australia on a temporary visa, so a short-term temporary visa, like a temporary shortage skilled visa, or a student visa, for example, then although you would be normally an Australian tax resident, you don't pay tax on any foreign income in gains. So, but coming to Australia on that temporary visa does offer tax concessions, and your foreign income would normally be exempt from Australian tax until you get PR in Australia.
Brilliant. Very clear. Look, let's dive into, I guess, the question on the minds of so many Aussie expats now. These proposed changes. We're meeting so many Australian expats who, have just told us, oh my goodness, we've taken all our cash out of the country. We've spent 43 days in the country and we're flipping out because what if we need to duck down there for a weekend? Or we've sold all our property, we're cutting ties. How do we give up our Aussie passport? There is just so much noise out there at the moment. So perhaps, I guess, you can give us a bit of a summation of what's going on, when these changes might come in, and what they really look like and who they might impact.
Yeah, for sure, Jarrad. It's a great question. And I think between, you, me, and Joe have done plenty of webinars on these new rules over the last couple of years. And there's certainly been in the media headlines a lot over the last 2 years. And there's been a lot of backlash from, the profession, from expats around the world over these new proposed changes. I mean, in a nutshell, what they look like, 2 years ago, the Australian government came out in a budget and said, looking to bring in a new proposed 45-day rule that effectively says if you spend 45 days in an income year in Australia, you'll be tax resident if you're an Australian citizen or an Australian PR in a nutshell. So the whole purpose was to really simplify the residency rule framework and bring it probably more modernized with let's call it the US and UK and other developed countries to bring in a very clear black and white day count test. The initial day count was proposed at 45 days. So if you're spending 45 days in an income year in Australia, you'll be normally tax resident. Now, at the moment, we've seen no draft law. There's been no announcement as to any start date with these new rules. So they're certainly just proposals at this point. But they did get a bit more I guess it was a consultation process end of last year that was announced by Treasury. So I think we'll probably hear a bit more on these new rules over the course of the year. Yeah. And I think just to also add to that, Jarrad, there was a fair bit of pushback on the 45-day limit as it's been too low. So I think there may be a bit of perhaps common sense there in terms of that day count increasing a bit more for 45 days.
Yeah, certainly. Speaking on behalf of our clients and the expat community in Singapore, certainly having something like 90 days or, potentially even longer would obviously be wonderful. Trying to push that out to sort of beyond 6 months, I think is probably getting a little bit unrealistic. But having 90 days, if you've got family back there, particularly aging parents, might be health issues, things you've got to deal with back in Oz. I think having a bit more leeway would be very sensible.
Yeah, so true. I mean, you come back for sort of Christmas, Easter, for a wedding, you're almost over that 45-day limit pretty quickly. So
exactly.
Yeah, it's not many days. But I think to the other point too, Jarrad, just quickly would be that the tax treaty network would also influence this 45-day proposed rule. And there hasn't been anything in concrete sort of said about how that's going to actually interact with this new proposed rule. So there may well be some exemptions if you're living in a tax treaty country, like Singapore, and you do trip over that proposed day count test. But obviously for expats in Hong Kong or the UAE, for example, where there's no tax treaty with Australia, it's going to have a bit more attention for those expats.
Of course.
Yeah.
That'll make sense. And I guess, broadly speaking, we've touched a bit on sort of what could be taxed in Australia, some of the misconceptions. What are some of the most common mistakes, I guess, or the common sort of disbeliefs, misconceptions people have about tax residency that you're meeting and speaking to?
Yeah, another fantastic question. I think the biggest one is probably this 183-day rule that you're not tax resident in Australia unless you spend more than half the income you here, which is certainly not true. It's actually quite hard for an Australian citizen or an Australian permanent resident to break Australian tax residency. You really need to make a clean move and a long-term move away from Australia. I mean, the ATO has ruled and done cases where an expat's been away for sort of 15, 20 years, right, living overseas, and has ruled them to be still an Australian tax resident by virtue of their Australian ties through Medicare, having Australian investments, having Australian property, and coming back to Australia for 3 or 4 months of the year. So it's actually quite a hard test to satisfy to become a non-resident. So that 6-month test is a bit of a misconception, I think. You can certainly be in Australia for less than 6 months and be a resident still. Okay. In turn, it's also possible on the flip side to be in Australia for more than 6 months and be a non-resident, if you can show that your usual place of abode is outside of Australia still. So yeah, I think that 6-month test is definitely the biggest one we see, and the other one is probably the fact that some taxpayers are under the impression they can leave Australia for say a year, 18 months, and live in Dubai, Singapore, for example, and become non-resident for that period. But really, it's got to be at least a sort of 2-year stay. Yeah, and the temporary visa point is one that often gets overlooked as well. Yeah, and just on that too, we often see that the temporary visa context is also important for New Zealanders coming to Australia. Just quickly on the New Zealand passport, they're actually a temporary visa holder for Australian tax purposes if they come to Australia on their Kiwi passport. So assuming they haven't got an Australian spouse, they're also a temporary tax resident as well, which can be helpful for them.
That makes sense. So let's sort of flip that on its head a little bit. You mentioned earlier that for the majority of people, remaining an Australian tax resident would in all likelihood increase their tax burden. And I must say, I couldn't agree with you more. But every now and then we'll meet somebody and let's say, I don't know, maybe it's their only real asset is their property, and they're sort of thinking through this whole main residence exemption and capital gains tax discount. Could someone, in effect, let's say they're moving to Singapore or Hong Kong, and the plan is to move there for 3 or 5 years, could they actually maintain their Australian tax residency through that period?
Yeah, for sure. And that's I guess a complex question for a number of reasons, right? A really good question because Australian property is a real key thing to think about if you're looking to move overseas and become non-tax resident of Australia. And the reason being really is that main residence exemption for your Australian main home is not available anymore if you're not residing in Australia. So if you're a non-resident of Australia and you sell your main home, you don't get that main residence exemption, which can mean significant tax when you compare that case to selling it as an Australian tax resident where it's exempt in full. So if you are looking to go overseas with Australian property, really important to plan around that point, because you basically must be an Australian tax resident when you sell your main home to get the exemption, which is obviously very important to get that exemption if you can. Now, I guess there are ways you can look to manage that sort of risk in that you can rent out the property for 6 years and retain the full exemption still. So one option to think about would be to go overseas, commence non-residency, you rent out the property for up to 6 years. As long as you come back to Australia and reside in Australia again and sell the property as a tax resident within that 6-year period, you can still get the exemption in full. But what you want to avoid is a situation where you're forced to sell it from overseas within that 6-year period, which can be a pretty big tax issue to. So I think on one hand it's the trade-off between getting the lower tax rates on your overseas employment income, paying a lovely 15 to 22% tax rates in Singapore, for example, which is nice, versus the tax on your main home. So it's a real balancing act, and like most things, as I'm sure you tell your clients, getting advice before you go to plan for these things is absolute key.
Absolutely. And look, I must say over the last, probably sort of 2-3 years, the number of Aussies who are sort of planning to become expats seeking advice before moving abroad, we've just seen such a phenomenal take up, which is, obviously, fantastic to see for us because, people taking their money seriously, the tax, everything else. Just so many ways it can go wrong.
For sure. Yeah, absolutely. And I think, tax is one aspect to it, but financial advice, is also really important. I think they very much go hand in hand too, in terms of you're looking at your overall investment strategy as well. As an expat, it's very different to living in Australia for the sort of financial planning perspective. So they very much go hand in hand, the tax and the investment side as well.
Yeah, absolutely. And I guess as far as sort of exiting tax residence, exiting the Australian tax framework, Australian tax net, what, I guess, a bit of a two-part question here, what steps do people need to take to exit? And then I guess, what documentation do you need to keep to sort of support that story as evidence, I guess?
Yeah, for sure. I think I guess, one part is how do you actually cease Australian tax residency? So in accordance with the tax office in Australia legally, it's obviously key. Secondly, when you do become non-resident, there are some really important points to consider from a capital gains perspective. There is an exit tax when you leave Australia that you can pay, or you can defer that. And that's never a simple question, that one, because the tax treaties can change that exit tax analysis, and there can be some benefits to paying it as well, which we can explain in a bit more detail. But yeah, really in terms of exiting the Australian tax system, it's really important to take the right step, so that there is a number of things you probably need to do in terms of cutting your ties to Australia through telling your Australian banks that you're moving overseas, getting off the Australian electoral roll. If you've got an Australian property, make sure it's rented commercially to a third party. Having your material possessions shipped overseas. So you really want to make sure you're cutting your ties to Australia on one hand, and on the other side of the equation, overseas, making sure you're doing the right things through having permanent employment contracts, having long-term leases overseas, having investments overseas. So it's a real case of showing through evidence that your life has actually moved to that overseas country. So yeah, because as I mentioned before, there's not one factor that really decides if you become a non-resident. It looks at all your factors: your employment, your business ties, your investment ties, your family ties, your social ties. Have you cut your social club memberships to your golf course or gym or church in Australia, and join those overseas as well? So yeah, really important to go through that checklist. And in terms of actually, how you notify the ATO, it's a system of self-assessment in Australia. So you would obviously, on your Australian tax return for that year, you depart Australia, file as a resident or non-resident, and that's the way you formally notify the tax office here that you've left Australia or remained an Australian tax resident. I mean, you do have the option to go for an ATO ruling, which is an option some taxpayers might take up if their situation is uncertain, or certainly an opinion from an accountant or a lawyer also would help as well. But I think that exit tax we'll just touch on that as well, if you don't mind, Jarrad, just quickly, is often overlooked too. And that this exit tax looks at effectively your non-Australian property assets. So it applies to shares, cryptocurrency, any foreign assets as well, which is often overlooked. If you had a property in, say, Singapore or New Zealand, it's actually caught up in this exit tax, which does catch people off guard. So you can pay that when you leave Australia. It looks at the gain you've made on those assets when you leave Australia. And normally if the gain's nominal or a loss, you'd elect to do that deemed disposal. However, if it's a significant gain, that's when you've got a real sort of choice to make, because you can defer that exit charge until you sell those assets. And certain tax treaties will obviously defer the gain to the country you're living in as well. So, for example, the US or UK tax treaties actually defer that exit charge gain to the local countries in the UK and US. So you just pay local tax in those countries. Yeah, but it's never a one-size-fits-all answer, that one.
So, and Brad, as well, another, I suppose, topical question that I get asked a lot is, when Australia's got a very, sort of rigid social security system and healthcare, Medicare, sort of what happens to, your entitlement to healthcare and Centrelink and stuff if your tax residency status changes?
Yeah, really common question, an important question too. So I guess first off, you don't pay the Medicare levy in Australia once you've become a non-resident of Australia. So you don't pay the first Medicare levy or the second Medicare levy surcharge for higher income earners. So you don't actually pay those levies once you've left, which is nice, I guess. So that's one aspect to consider. Now with Medicare, as an Australian expat, you can use Medicare for 5 years while you're overseas, and still use your Medicare. But it's also, I guess, a case of just being mindful that if you are using Medicare, especially back in Australia, then it does sort of point towards tax residency of Australia if you're coming back and using that system regularly. So something to consider. There's also this private hospital loading surcharge that is also a common question we get. I'm sure you guys get this question too, is what happens if you're over 31 and you don't have Australian, private health cover? Because normally you'd be subject to a loading surcharge if you haven't had that in place after you're 31. Now, luckily, if you're an expat, you can normally avoid paying that loading surcharge. Just need to get a passenger movement record from the Australian government to show you've been overseas, and you give that to your health fund when you return to Australia, and normally you're exempt from paying that loading surcharge. Yeah, but certainly, becoming a non-resident does impact other things like your pension, your age pension entitlement. There's certainly a residency requirement there to access the Australian pension as well. It's normally a 10-year Australian tax residency requirement to get access to that pension.
Mm-hmm.
Yeah, so
I suppose broadly, yeah, they want you need to be contributing to the taxpayer funded system that enables you to get those sort of entitlements.
Yeah, exactly. That's right. Yeah, some countries under the bilateral social security treaties also allow you to claim in the source country you're living in too, like the UK and US. Yeah. Normally, you could do that.
Yeah, of course.
Yeah, but obviously a really important question too to think about that for sure, because it would obviously be a big impact for expats to lose that pension living overseas. So yeah, really important consideration, and your super planning. Of course,
for sure. Well. And that it obviously flows into a longer term retirement planning piece that, making sure that, what entitlements you would be entitled to, and knowing that whilst you are a non-resident, and, making sure that your retirement plan is actually going to be viable.
Absolutely, for sure.
Yeah. Now, I've also got, a couple of many clients actually, that live overseas and they have children. And for example, they send their children back to Australia for the purpose of, say, for example, attending university or doing some other sort of study for the kids. But though the parents essentially can remain overseas, is there any sort of broader tax considerations that I suppose the parents need to be aware of? For example, they've got family now, they've got their kids living in Australia, but they're maintaining a non-tax residency.
Yeah, I guess we see it a lot, don't we, with our clients? I think all three of us, where family's gone overseas and then the kids obviously want to go back to Australia to go to school or university, and what does that mean? Obviously, having a great education system in Australia is key to that. But I think that the important thing initially would be tax residency, right? Having kids back in Australia is a stronger tie to point towards tax residency for the parents as well. So normally, of course, for the parents, normally do not want to trigger Australian tax residency early. For example, if you're in Singapore and you've got the kids back in Australia, you just need to have a bit more care in terms of your trips back to Australia, especially, for example, if you were to, say, buy the kids a home to live in back in Australia and you're coming back and living in that home when you're back in Australia, that can be a test of residency. So something to be mindful of. And then it's all obviously just about making sure any future tax planning as well for the kids and the families is done well through looking at family trusts as well, probably at that point. But yeah, it's probably a wider conversation on the investment side as well in terms of repatriation. Yeah.
Brad, look, mindful of your time, I might just throw a couple of final questions your way, if you don't mind, because I feel like we could continue down this rabbit hole of tax residency forever. And I think we'll certainly have to have you back on the podcast for a future episode. But I guess just a final couple, one, broadly speaking, what are some of the sort of traps, pitfalls that Australian expats tend to fall into that you see when they return to Australia? Maybe they're not prepared for, not planning for, not thinking about, or even just totally unaware of.
Yeah, definitely. So I think a couple of big things we see, like, first off, when you come back to the Australian tax system, it can be a bit of a shock for expats, right? You're coming into a very high tax country. You're sort of probably used to paying lower tax rates overseas, and then you come back to Australia and bang, you're faced with 47% tax. Once your income hits sort of 180,000, which is a relatively low threshold for expats these days. So I think that's the first point to be mindful of, and it is generally pretty hard to get that tax burden down. On the employment income side as well. So I think certainly be prepared for a higher tax bill on the employment income side. But I think it's really important to also look at, your overseas investment structures, pensions as well, when you do come back to Australia. I mean, the biggest upshot or the benefit of coming back to Australia is that any foreign assets you accumulate do get rebased to market value when you come back. So if you've got, shares you've acquired through public shares or employee shares or overseas property, that all gets rebased to market value when it comes into the Australian tax net, which is a huge benefit. So that means you're really just paying Australian CGT on the increase in the value of those assets after you've moved back. So make sure you get valuations done on your foreign assets when you do arrive back to Australia. But I think the biggest things we see would be, especially if you've got an overseas pension, for example, normally that's not going to be qualifying as super in the eyes of the ATO, unless it's from the UK. I mean, the UK ones would be, but normally if they're a Singapore CPF, for example, or a US retirement plan, they're normally not qualifying for Australian purposes. And it's really important, I think, just to plan how to handle that before you come back to Australia as well. If you've got any employee stock vests as well, just think about how to manage that. You don't want those stock vests normally getting caught up in the Australian tax net too early, if you can avoid that. And then the final one is probably any overseas structures. If you've got an overseas trust through an estate, through parents, US trust or Hong Kong trust, Singapore trust, or a Singapore company, for example, just how to best manage that as well when you do repatriate to Australia. Because there's certainly some planning that could be done to help ease that burden as well. Yeah.
Makes a lot of sense. And I guess final question, if you could pick just one golden nugget, one, the be all and end all piece of advice, one liner, what would it be? And let's pick 4 Australian expats to at least, I guess, narrow down the scope a little bit for you. Yeah. So for all of the Aussies living all over the world, what's the number one piece of advice when it comes to tax planning?
Yeah, it's a really fantastic question. Speak to somebody like you guys first. Obviously, I think having quality, advisors in both countries is key, right? And not just the Australian side. You need joint and integrated advice. If it's US, Australia, Singapore, Australia, because you can never look at one country in isolation with these things. So certainly find good advisors that can look after both, sort of host country and the country you're moving to. Really, really key. Yeah, plan early for sure, both on the tax side, but also financial planning side. There's never too early. I think, if it's 12 months before the move, that's probably the minimum time I'd recommend, planning for the move. And then I think just staying in regular contact with your advisors too. I mean, the rules are always changing, looking at Australian tax residency rules, looking at superannuation limits and caps and what you can do on your super. So definitely stay in regular contact, just schedule a regular meeting with your advisors every 6 months or so. I think too, don't forget about Australian retirement planning too. I'm sure you guys will see it a lot. Your Australian super is a great vehicle to accumulate wealth tax effectively, even for expats. So I think really look at that carefully in terms of how you can utilize those benefits in the super environment back in Australia. Yeah.
Absolutely.
I think so. One more thing, just quickly, so I know I'm talking a lot. And just have a bit of a roadmap too. I think it's always good to have a tax and financial planning roadmap, in terms of short, medium, and long term. It really does drive outcomes and can really save a lot of money long term.
Absolutely. Well, look, obviously we couldn't agree more with seeking advice early, and likewise, you've obviously helped a number of our clients over the years, and I'm sure many, many more over the years to come. We're really lucky to have you, in the network and have your expertise and knowledge to share with our clients, and obviously jump on, the Money Side Up podcast today. So really, really grateful for your time. Really grateful for you sharing your expertise. As I said, so many more things we could cover with you. So we'll definitely have to have you back in future. Tax is, one of those not necessarily exciting topics, but one as expats we all need to be incredibly aware of. So on behalf of us, huge thank you, Brad, for giving us your time today.
Yeah, my pleasure, Jarrad and Joel. Thanks for having me on. It's been great. Thanks, Brad. Look forward to the next one.
Wonderful. Thank you very much, Brad. We'll let you go, and we will be chatting soon, I'm sure.
Fantastic. Have a nice day, everyone.
Thanks so much for tuning in to our interview there with Brad. So as mentioned in the first episode, we'll be releasing a podcast each month on the last Wednesday of the month. We'll be interviewing an expert each month on topics ranging from how to select the right ETF for your portfolio to distinguishing whether a trust is right to set up if you're an Australian expat, so on and so forth. The podcast is on all major hosting services, so you'll be able to find us. Please subscribe and check out any resources we're creating as part of the podcast. And of course, leave us with your questions. You know, we're here. We'd like to obviously open up this conversation very broad towards the Australian expat market. And yeah, we would love to continue to hear from you.
Thanks, Joel. So obviously, if this appeals to you, if this is something you enjoy, something you like, check out our socials. It's at Money Side Up. We're on Instagram, Facebook, Twitter, X, depending on what you prefer to call it these days. LinkedIn, and as Joel mentioned, of course, all of the podcast services and YouTube. If you'd like to both see us and hear us, then of course, check out the YouTube channel where all of the podcast interviews are up. So you'll be able to check those out as well, depending on how you prefer to digest information. Now, next month, we've got an estate planning lawyer in Singapore covering all things estate planning for Aussie expats living abroad, not just in Singapore, but all over the world. So don't miss that one. We see far too many mistakes made in that space. So a great one for new and old Aussie expats to tune into. So huge thank you for tuning in today. Hope you got a lot of value out of it. Really look forward to seeing you in the next. Leave us a 5-star review if you're enjoying the content, enjoying hearing from Joel and I. But look forward to seeing you in the next one. Have a fantastic week ahead.
Thanks, everyone.